Good morning and hello everyone. I'm Tony Brown of the Trade Advisory, an international trade consultancy, details of which you can see in your materials. I'm delighted to spend the next 50 or so minutes addressing our subject, the anatomy of a bad deal and what true supply chain finance is all about. Thank you, GTR, for the opportunity. I should assure those of you with a sensitive disposition that the reference to anatomy in the title does not mean that we're going to be dissecting any cadavers, nor should you expect any gory pathological post-mortem of lenders or rogue credit insurers. As you'll see, our panel of top-notch experts have donned business casual attire instead of hospital scrubs. So without further ado, let me quickly introduce you to them. Their full bios are actually in the materials. And I'll start with the gentleman who is most far away, Rakshith Kunda. Hello, Rakshith. He is a managing director and the head of trade product sales, Asia Pacific, for global transaction services at Bank of America. And he leads a team focused on structuring and delivering trade and supply chain solutions to corporate and financial institutions, clients across Asia Pacific. Then we go to my friend Todd Linnedy, who's managing director and global head of insurance sales and business development at LiquidX, a provider of technology solutions for working capital, trade finance, and insurance. In his role, he's responsible for leading the firm's sales, origination, and business development strategy for the LiquidX trade credit insurance digital platform. Then my neighbor here on the Upper West Side in Manhattan, Seb Kafetz, is managing director, head of global transaction banking, North America for Lloyds Bank, whom he joined in 2002 in London. In this role, Seb manages a team providing both product and sales coverage relating to the provision of trade, finance, and cash management. And last but not least, in California, Bob Glockfelty is VP of Growth, and they have been growing, at Tolya, responsible for driving adoption of the supply chain finance technology platform by customers' suppliers. Tolya worked extensively with Greencell until its recent failure, and is now focused on multiple funders, including JP Morgan, a strategic partner. Thank you all very much for being here and for sharing your insights. We've got about 50 or so minutes with some Q&A, which I would encourage everybody to take part in. And perhaps, if I may, and ask our technical wizards to flash up a title slide of Payables Finance, can I ask you, Rakshith, to set the scene by explaining what actually is buyer-approved payables finance and how it differs from other forms of supply chain finance? Over to you, Rakshith.
Thanks, Tony. That's probably a great place to start the discussion. Probably one way to understand it is through the common principles of payable finance that BAFT articulated in a paper back in 2020, building off the work by various previous forums. It's articulated on the slide, but broadly, buyer-approved payable finance programs are, of course, buyer-led and based on two sets of agreements. One with the buyer, which very importantly contains an irrevocable undertaking to pay the payable, and another with the supplier, which includes the assignment of rights on the receivables as per the relevant jurisdiction. These are generally separate sets and tripartite agreements are not involved. Another element is the whole aspect of choice to the supplier in availing of the discounting, and that the payment terms should be in line with the industry. Such programs are typically uncommitted, and there are various funding structures where multiple finance providers can participate, say through risk participation or other forms of funding. Approved payable finance is also not the same as traditional factoring due to the undertaking by the buyer and the fact that commercial disputes are handled outside of the program itself. Essentially, that mitigates performance risk for the financial provider. To that extent, the programs and pricing itself is based on buyer risk. Generally, it discounts the full value of the invoice to the supplier, and there is no recourse to the supplier for non-payment by the buyer. More recently, we have seen a number of programs that rely on the irrevocable undertaking by the buyer and do not look to purchase the receivable, so to speak. In January this year, the Global SAF Forum actually released a paper where they decided that the term corporate payment undertaking is an appropriate name that captures the essence of such techniques. In fact, this has led to a creation of a new subcategory of techniques under supply chain termed as advanced payable. Coming back to approved payable finance, clearly there needs to be a payable on the books of the buyer and an irrevocable undertaking by the buyer to pay the payable. That is no performance risk to the finance provider. To that extent, probably anything that is based on payables or receivables that will only crystallize in future would probably be difficult to categorize as approved payable finance. Apart from such receivables, I think the other category where questions are often come up with is around project finance. Project finance relies on future projected cash flows for sure, and has traditionally been on-balance sheet funding at an SPV or borrower level. Theoretically, you may have projects that have a guaranteed future flow of receivables, but in most cases, they're not. You'll probably find a performance risk element embedded somewhere in there. That, Tony, I think pretty much captures the essence of what one would say is payable finance and the principles around it.
You bet. Does anyone have any comments before I ask? Well, actually, let me ask this question and you can all comment as you think appropriate. So with that construct, it seems to me that some of the types of things that were practiced recently, particularly by Greencell, wouldn't fall into that category. Now, I know that they did a lot of what you've just said for Vodafone and other very large investment grade buyers, but where does, I think you alluded to future payables and we talked about project financing and payday lending. Where do these fit? Obviously, they don't, but there's confusion. Anyone?
Yeah, I'm happy to jump in. I think you're spot on, right? So I'm no expert on Greencell, but if you look at what they did a variety of different things. You can see that in the companies that they acquired or the different components that they've shared publicly. And I think while they may have branded themselves as a supply chain finance company, what you say there is absolutely spot on, right? They did a whole bunch of different things, and a lot of those things, they weren't payables finance. And so I think when if you think Greencell and you think payables finance, or you think Greencell and you think supply chain finance, yes, that's true. They did those things, but it's not everything that they did. And so I think a lot of what got them into trouble had really nothing to do with payables finance. It was things that the media refers to as future payables or different things like that. And I think it's important to really recognize that that's really not what we're talking about here when we talk about payables finance. And as an industry, I think it's really important that we're discussing this topic and we are really open about what are these different things they were doing, what meets that definition of payables finance, what is it, what isn't it, and then really be clear about those differences. So true payables finance has these things that Rakshith just talked about. You have a buyer approving a payable. It's a very stable, resilient mechanism, and some of these other things they're really just not payables finance.
Yes,
I think you hit the nail on the head that stakeholders now are going to ask a lot more questions. In the past, people saw everything under this bucket, and people brought funds based on the supply chain finance bucket and expectations of how a deal may be structured that were incorrect. So you're going to see all stakeholders, whether it's buyers, suppliers, especially investors, really do more due diligence and really ask questions to ensure that the program that they think they are underwriting or that they are arranging meets the definitions that we just saw. And we're going to delve into a lot of what's good and what makes a bad deal as we go through this panel, which is going to be exciting. But expect a lot more due diligence, and therefore deals, quite frankly, to take longer to arrange and get executed, because you're going to have more questions being asked, which is good.
Thank you, Seb. Yeah. So let's get into the risks of approved payable finance, or I'm going to call it payable finance, and how they can be avoided. Obviously, as we just discussed, Greencell arranged traditional payables finance. There was a large component, but a large component of their business wasn't. I've heard it said that there would be 50 to 80% that actually didn't comply. And so where is the area of misbehavior or fraud here? I mean, was there, a baiting and switching going on where they were saying one thing and delivering something else? Were there fake invoices? There's a allusion recently to the existence of a fake $30 million invoice by Liberty Commodities to Trafigura included in the pool. There were circular transactions potentially between GFG Alliance and SoftBank investees. Where is the opportunity for fraud, and how do we detect it, and how do we avoid it? Bob, I think I'll ask you that, and then we can have everybody's input.
Yeah, happy to kick us off. I mean, I think again, let's start with the definition, right? So approved payables finance, or I'll also just call it payables finance going forward. It's generally a buyer-funded program to start, right? You have a buyer and they're bringing on their suppliers and they're providing finance through that mechanism. And so, some of the things you've alluded to and some of the things I read in the news, something like a future payable, that, if there isn't an invoice, the buyer isn't really the sort of sponsor of that transaction. So again, you're into something very quickly that isn't payables finance. And so I certainly don't know how much of their business was payables finance or other things, but as you alluded to, and I think the press has stated, that's a very large component of the business. And so, if you brand yourself as supply chain finance and you're doing other things, then it may look like that's payables finance, but it's really not. So I think an example might be, take like Walmart or Target, right? Is that a supermarket? Absolutely. They sell groceries, they sell food, they sell produce, but they're also doing all this other stuff. And to call Walmart just a grocery store isn't an accurate characterization. So I think when you talk about these elements for Greencell that got them in trouble, from what I've seen, it's really not payables finance. And I think really that distinction and knowing what's going on and knowing what you're doing is important. And as Seb said, it's on, it's a requirement of all parties to understand what they're doing and what this finance really is. And
thank you, Bob. How about everybody else on this? There was a wide gap here. Any other comments?
So Tony, one of the things I was going to say, I think it comes down to the lack of transparency and visibility into the assets being actually financed, not necessarily by Greencell, but their investor base, right? Because when you think about it, they were selling huge pools or portfolios of assets to Credit Suisse and others. And they basically relied on the reps and warranties of Greencell that this was supply chain finance. So, what we're seeing now is a lot of entities wanting to see that granular level of that invoice data, because if that was available, it could have been Credit Suisse, it could have been, whoever else that was interested and had some sort of interest in these assets. They would have seen that there is no invoice attached to a future receivable. It might be contractual, but there's no invoice. There's no invoices that were, I was reading Igor's post yesterday on LinkedIn regarding GTR. There's no invoices there. There was no invoices for the West Virginia governor's coal mine. So how these were then put into a supply chain finance fund and then invested against it, it's really interesting. And it just shows.
Well, how can there be an invoice when there hadn't even been contact with a buyer?
Well, that's what I'm getting at, right? So if there's no invoice, there's no obligation. However, some of these future obligations were thrown and packaged into the larger portfolios based on reps and warranties coming from.
Right, and those are working capital loans. That's not payables finance. Anybody else with a comment on this? No. Okay. So let's move on then. So there are potential fraud risks here, but there are also credit risks and commercial credit risk underwriting. And I just want to sort of understand here. Greencell did make some bad credit decisions. Some of their buyers went bust. I think Bright House did, NMC Health did, Agri-Trade did. So what are the implications for credit risk underwriting? What are the appropriate terms of payment? How do you sort of square that circle to make sure that people are not abusing term extension? And what do you need to do to make sure that the appropriate security is in place so that your invoices are indeed secure and cannot be attacked, for example, by the secured lender of a supplier? I'd like to perhaps ask Seb that question since you've been quiet for a while.
Thanks, Tony. Yeah, delighted to. So let me talk about two different related points, credit risk and then structural risk. And, we talk about the anatomy of a bad deal. For as long as supply chain or payables finance has been going, the key risk to all parties is essentially credit risk on the buyer. As we've all said, from an investor perspective, you are paid back, by the buyer to the extent that there's a default there. So credit risk on the buyer is key. And this really comes back to how do banks underwrite those buyers? And traditionally, payables finance has been arranged by big banks, big financial institutions, and relationship banks that are coming in and doing the underwriting. So underwriting looks very similar to how we would underwrite a loan, a revolver, and you have access not just to financial statements, but clearly you have access to management at the buyer. And that's really important because you can get information about what other programs exist that may not be clear in the financial statements. You can understand working capital cycles, and that lets bank underwrite. I would say that banks, because these facilities are uncommitted, clearly they would look at them in slightly different ways and probably more favorable terms to committed revolvers, but nonetheless. The issue we've got is as more investors have come into the industry and traditional banks who are arranging deals have been supplemented by platforms, by funds, the investors are getting further and further away from that ultimate buyer. So, to one extent, there'll be financial statements they can rely on for public companies or private companies will provide them, but you're underwriting just the financial statements. And that, has complexities, as we said, not always are the degree and the amount of these programs provided in the financial statements. You then have what happens with Greencell, where you have actual, various different buyers pooled into a fund. And at that point, the investor of that fund really has no insight into the buyer that they are underwriting. As we said earlier, as Bob just said, they're really taking the word off the fund managers to provide that due diligence on their behalf. So the investors are getting further and further away, which makes it really hard to underwrite the buyer, which, as we said, and as I said at the start, is the key risk in these transactions. So that's something that's really important to understand. We then talk about structural risk. And as you move down the credit curve from investment grade to middle market type clients, that becomes more important. And there's a few things on structural risk, Bob and Tony. The first is making sure that the loan and the terms of the loan really are concurrent with the cash conversion cycle. This really should, as we said in principles of payables finance, we really should be matching the finance to the conversion. And there's examples where that didn't happen, Carillion being one. And at that point, these facilities do look more like term debt for the buyer. And then you get into the accounting considerations that I know we'll touch on, and there's a panel later, as opposed to looking at short-term working capital. And then you talk, Tony, about how can banks think about perfecting security? How can we ensure that these receivables are not financing multiple different loans from multiple different investors? And there's ways to do that when you go down the credit curve. UCC filings are definitely one aspect of doing that. generally these don't happen at the IG level, but they do it mid-market, and or using negotiable instruments where banks could have some tangible security. And that could be credit notes, that could be bills of lading. There's a whole number of structures. The industry has predominantly got away from that, but some of that may come back as investors really look to have some tangible security sitting behind those invoices. Really great. Thanks, Seb. So can we sort of move on from these the risks themselves, but talk about how they differ, how they are managed as between different platforms. Obviously, you work at a bank, Seb, and so do you, Rakshit. And so when the bank deploys its own money to its customers, that's one thing. But when you deal with a non-bank or a shadow bank, as they've called Greencell, and Greencell's not regulated, that's another thing. Invoice platforms, auction platforms, and I know you'll make some distinctions, Todd, about LiquidX versus the predecessor receivables exchange, and procure to pay programs. These are all very different platforms. Do the risks in payables finance vary according to them? Perhaps you could answer that, Rakshit.
That's a really good question, Tony. And see, again, to repeat what Seb said, the core credit risk for the buyer being able to make payment remains irrespective of platform or the method you have. And it's quite fundamental. If the buyer is unable to meet its obligation, there is a default. To that extent, irrespective of the structure, the due diligence on the buyer is critical and core. What does probably how it would change is that other risks might arise depending on how the platform or the provider actually structure the transaction, or to an extent even raise funding. For example, imperfections of assignment of receivables gives rise to risk of conflict with the supply secured lenders in event of, say, supplier bankruptcy, something I think briefly Seb alluded to. In some cases, if the undertaking to pay on a particular invoice is based on an automated matching process, risks might arise if the process itself is not sufficiently robust. It can also be due to the nature of how it's funded. How far away is the investor from the actual underlying, and how much of probably access, visibility, and due diligence is possible. To be very clear, this is not really specific to payable finance itself. It arises in all cases where you have an investor investing in something that they do not have direct access to, be it mortgage securitization or invoice auctions. There's always a risk that arises due to how much due diligence is possible. I think what's important is not only to understand the end-to-end structure of any program from a risk perspective, but also to understand how those risks are allocated. Where do they sit and who actually bears it? Remember, supply chain finance encompasses a lot more than just approved payable finance. Industry forums have spent years trying to define it. So it's very important to use that framework and really understand what it is that drives the risk in a particular structure.
Yeah, excellent. Anyone got any comments on Rakshit's remarks?
Yeah, Tony, I could add something. I agree with your comments, Seb's, as well as Rakesh. And when it comes to platforms, I think it's really important to understand, what are some of the additional value-added services those platforms are offering the investors, right? If you're just an open platform and taking anyone in, obviously that's much higher risk. And we've seen some of those type of platforms come and go because of fraud. And it's also, let's say, the type of entity that is going to onboard that platform. Like for instance, just to give you an idea with LiquidX, we have a certain size criteria. We have a threshold. Anything below that threshold doesn't even get any sort of consideration. Then we also look at management, the background of management. What have they done? And most importantly, once we finally get through the KYC, AML, and all that background, let's say underwriting of that particular supplier or buyer for that matter, we set up calls with our funders, regardless if it's AR financing or payable financing, to kind of bridge that gap that Seb mentioned before, where a lot of the platforms and a lot of the investors that are so far away from the transaction, we try to bridge that to ensure that there's that comfort level and get a programmatic type of funding structure in place so it's not a one and done or overly opportunistic, because that's where we see a lot of problems and where things really go sideways.
Yeah, got it. Can I now talk about technology? Clearly, there's a move away from paper. We're going to digitize processes, digitize documents. There's a wonderful effort underway with ITFA and others to actually create electronic bills of exchange. And obviously, there are electronic bills of lading. Is digitization, e-invoicing, and the rest of it likely to help in the management of these risks? Since Talia is a technology company, a fintech, can I ask you, Bob, to address that?
Sure. Yeah, I think the technology layer around all this is hugely beneficial for these programs. So, a simple example is if you can approve an invoice quicker using electronic invoicing, you have a longer window of acceleration for the supplier to take an early payment. If you have an automation layer, you can handle things like credit notes that can be very tricky to manage when there's hundreds of thousands or even millions of invoices. So I think the technology layer is providing a ton of value, and if you're not bringing that on, you're kind of missing out. You can absolutely do payables finance without it, but there's a huge amount of benefit that comes from it. I think there's some elements that'll help mitigate risk, and Todd mentioned some of those earlier. But really, it's a layer around this that just makes it all function much more effectively, and the benefits go far beyond just the risk elements.
Comments, anyone? Okay, I've got a quick question from the audience here. When will another Greencell pop up? Or was Greencell just an aberration or a unicorn?
I think someone said it earlier. I think it was probably Bob, in that I think it was you, Tony, shadow banking, where there's a private debt fund set up to invest in a whole different range of assets. There's a plethora of them right now, and it's hard to know what these guys are doing, because for the very nature they are private debt funds. They find their investors, but they are doing all sorts of different trades, including trades that look like payables finance, but which we have alluded to are not payables finance. So in my view, they are out there. They're probably a lot less concentrated than Greencell. I think the majority of investors for these funds are sophisticated investors. We're not aware of that many of these supply chain finance funds in the way that Credit Suisse were marketing, and you probably won't know about a lot of the defaults. But we're seeing it across all asset classes of potential defaults, whether it's leverage finance or others. And we've got to assume, and we know that increasingly these funds are looking to do shorter term working capital type trades within their funds.
Thank you. Let's move to the subject of credit insurance, an area, Todd, that obviously you're a specialist in by virtue of your background as an underwriter, and I think you were also a credit insurance broker, highly respected. Credit insurance is the nub here for the Greencell event. It was the withdrawal of it, the concentration of it, that caused the implosion of the funding for the program, and therefore the implosion of the company. Why did it fail? What was there notice of the termination? Why wasn't there efforts made in the 6 months that apparently there was notice to put something else in place? Was it truly just about COVID, or was there bad underwriting and people just got scared off? Was the concentration risk of the customers too great? Can indeed credit insurance cover future receivables? I was listening ad nauseam to Lex Greencell's testimony to the Treasury Select Committee, and he said that those future receivables were indeed credit insured. that there was some form of insurance against the insurance receivables never happening, and indeed that they were totally secured. It's awfully confusing. Can you shed some light on this?
Yeah, there's a lot to bite off there, so I will break down.
You can do it. You can do it, Todd.
So in terms of future receivables, since that's what you just mentioned, in traditional trade credit insurance, a future receivable is a receivable that does not exist by definition, right? So when you look at trade credit insurance, a product or a service needs to be delivered, accepted, or performed, right? And that leads to a receivable being insurable for a particular transaction. Now, they might have had different insurance, maybe performance insurance in terms of if those future receivables didn't come in, but that has nothing to do with trade credit insurance. And I do not know anything about that. When you look at the withdrawal of the credit insurance policies that Greencell had, right? They had 9 months to act. That is 4 times the normal notice period that trade credit insurers by regulation are required to give their clients. Typically it's like 60 days. They had 9 months, all right? So that's one thing. Number 2, you also talk about the high concentration with Tokyo Marine. I think it's unfortunate that they were in the papers as much as they were, because Greencell at one point had upwards of 15 to 20 different insurers on their panel.
They had 28 apparently.
Yeah, right. So you had a tremendous amount of underwriters involved in these transactions. And, you know, you mentioned COVID. That brought the risk awareness of every underwriter to the forefront, right? So anything that they didn't necessarily, they're all revisiting their portfolio, right-sizing their risk. And what you end up seeing as well, Greencell's programs historically were incredibly profitable. There wasn't many losses that exceeded deductibles. They actually were structured pretty nicely. Towards 2019 into 2020, you saw some losses come through that started hitting the underwriters, which led well-known underwriters as well as some of the smaller regional players and say syndicates to get off of Greencell's policies. No one talks about that, right? You talk about, oh, there was $4.5 billion with Tokyo Marine in Australia, and this led to the downfall. That didn't lead to the downfall. They had 9 months to find a new underwriter. They couldn't. And really, as everyone has discussed already, poorly structured, aggressive underwriting, and maybe a lack of or unappreciation of proper risk management protocols were really the downfall.
So on that point, which is very important, let's talk a little about the termination versus attachment. Just because someone withdraws coverage doesn't mean to say that everything that's been done up until that point of termination isn't covered, correct?
That is correct. Most policies are risk attaching. So if for some reason, let's say the policy non-renews tomorrow and there's any insured transaction occurring today, that is indeed covered for a period of time called a tail. And typically tails could run upwards of 180 days, especially for short-term transactions, which from what we understand these were. And that's 180 days past the obligation date. So if it's net 60, it's actually net 60 plus another 180. So there's plenty of risk tail for these policies that could have kept investors or lenders somewhat comfortable, at least in the transactions that were on the books, if they were insured.
And the funds themselves, were they a loss payee from these insurance policies, or were they a named insured?
My understanding from what I've read that they were loss payees, which makes sense because one of the principles of any insurance is insurable interest. And you need to have an insurable interest, which means ownership of an asset to be a named insured. When you, go ahead,
sorry.
I was going to say, having security interests, which I think is the way Credit Suisse and some of the other investors structured their agreements with Greencell, that's where the loss payee structure comes in.
So let me ask you this question. If lending against future receivables is not payables finance, and it is working capital loans. It's a loan. Forgive me, but I thought there was some regulatory restriction on the part of credit insurers that they could not guarantee loans, that they had to be involved in trade transactions. Isn't that a regulatory hurdle? And how the hell did someone manage to get credit insurance to protect against the non-payment of a loan against a future receivable from a buyer who hadn't issued a purchase order, let alone hadn't yet been contacted?
That's a great point. You know, here in the States, very tough regulations in terms of insuring loans, which is viewed as the financial guarantee, where underwriters could lose their license in New York. And if that's the case, they might as well just shut down their shop. Internationally, I think that, you know, certain jurisdictions are a little bit more liberal than others. But with that being said, Tony, trade credit insurers, the ones I've worked at, the ones I've worked with, they all need that underlying trade, which is built into their reinsurance treaties. Now, there are a few underwriters that will do non-trade business, but with that being said, these facilities were all viewed as short-term payables, receivables financing that would have been insured under a traditional trade credit insurance policy. If there was other sort of financial guarantee programs used or other sort of performance insurance, like maybe a surety, and that's an assumption on my part, yes, that could have been potentially leveraged. But again, the underwriters and all of the partners within part of that insurance transaction are going on the reps and warranties of the insured. And if they're saying that, oh yeah, this is good, this is all fine, and there's no visibility to the underlying invoices that may or may not be there, Credit Suisse is basically going off the underwriting they did of Greencell and saying, you know what, we have to take what they say as face value.
Yes, and there's some very interesting reportage and analysis of this. I would encourage the audience, if they're interested in this, to go and look at the Fitch reports on this, particularly on credit insurance, because it talks about how reliable credit insurance is for payables finance and what investors should be looking at. Don't want to harp on that now, but I would like to ask anyone else on the panel on this subject of credit insurance if they have any comments to add to Bob's. Don't all shout at once. It's a tricky area. I'll give you one point here. Regulation about credit insurance. It seems that, you know, this old adage that you can always get credit insurance. It's like when the sun is shining, but it's a bit like, you know, when it's raining. They'll give you an umbrella when it's sunny. What happens when stuff goes wrong? Credit insurance is sort of pro-cyclical, if you will, and when stuff goes wrong, they withdraw coverage at the very time that people need it most. And so, should there be more regulation on this subject, on this topic, to protect the insured and any funders who are relying on it?
I think that's a good question, Tony. And I think that there's a few things just to keep in mind. We talked about it before that regardless of any sort of risk action that an underwriter may take, anything that is outstanding up to that point does attach and coverage remains in force. But with that being said, there's also, like, every single underwriter, especially the cancelable underwriters, have implemented what is called delayed effective cancellation. So if they send you a notice today that they're going to take action on a particular account debtor, typically that action doesn't go into effect for another 30 to 60 days. And most of the contracts or most of the buyer-supplier relationships aren't long-term contracts. They're able to basically, the parties are basically able to append the contract. And, you know, part of credit insurance is not necessarily just to insure, you know, risks full stop. It's also part of a risk management tool to say, hey, we have these red flags. We want to show you what's going on. And based on what we're seeing, we want to revisit our risk position on this particular entity or industry or whatever the case may be. And, you know, my industry has gotten, you know, hit pretty hard in the press, 2008, as well as with COVID. But if you look at COVID wasn't as bad, but in 2008, loss ratios were on average upwards of 130 to 150%. Some underwriters here, you know, the best loss ratio I think I've seen with the traditional credit insurers post-COVID was, I think, upwards of 70 or 80%, with some going as high as 150 to 200. So right. The product works.
Thank you very much. Let's move on. Let's move on to supplier and buyer considerations in structuring new programs. What should they bear in mind? Seb, do you want to tackle that one?
Sure. Thanks, Tony. And you know, we're in a bit of a paradox right now post-COVID, when these programs are as important, if not more important, to buyers and indeed suppliers, as we really start to get trade moving again. So we're seeing, you know, a significant uptick in interest about putting these programs in place. At the same time, however, we're seeing these programs take a lot longer to get approved at the buyer level. And there's 4 quick things I want to touch on: the authority to bind the buyer, structure and funders, accounting regulatory impacts, and alternatives. So let me touch on them quickly, Tony. I think authority to bind the buyer, you know, historically, this was put in place at treasurer level, assistant treasurer, as part of working capital management. We're now seeing, you know, generally these programs have to get signed off at board level, you know, definitely at CFO level, because from the reputational risk perspective, you know, no buyer wants to be in the situation where their program is suddenly on the front pages because it's been sold to a platform where, you know, it's getting caught up in other things. And, you know, Greencell is a great example in that we've talked about the negative deals that went through that platform. There was plenty of good business with blue chip clients, with strong investors through that platform. And, you know, those buyers have been dragged into some of the complexities with, you know, Greencell going into administration, you know, finding a new payment agent, dealing with the trustee, and, you know, corporate treasurers and CFOs don't want that hassle. So that's going to be important. Structure and funders, again, we talked earlier about this, but increasingly buyers are asking now, who are going to be my funders? You know, they want stable funding. You know, they don't want, I think Bob mentioned, or Todd mentioned this earlier, one and done. They don't want investors that come in and out. They want to know that, you know, the buyers or the funders will be there through the cycles, through period ends, so that their suppliers, you know, always have that option, you know, to discount when they want to. And that's really important as they look to keep a sustainable supply chain.
Yeah, I think just to sort of chip in one quick comment, I think Talia would agree. They were sort of tied to Greencell as their exclusive funder at one point in time, and clearly that didn't work for them. Now they've got JP Morgan and a few other strategic partners. So having all of your funding eggs in one basket is not a good idea. Back to you, Seb.
Yeah, I agree, Tony. You know, we talked about accounting regulatory impacts. There clearly is fear about what may come if this product has to go on balance sheet, because clearly at that point, you know, this product goes up against capital markets and long-term loans. But therefore, it is in the buyer's interest to make sure these are structured appropriately, that these do look like accounts payables. And, you know, the most successful programs we see, not all suppliers take it up. So these are big lines in place. You know, utilization is generally 50, 60%. You know, the terms match the cash conversion cycle. So, you know, the CFO can talk to their accountants and look them in the eye and say, this is a purely working capital tool that we are using to keep our supply chains going and aid our suppliers. But, you know, the last point is alternatives. There are alternatives to this product. You know, in-house dynamic discounting, where essentially, you know, the corporates take this in-house, is an alternative that we are seeing more of. Working capital loans, where, you know, banks will lend, you know, against, you know, a pool directly with the corporate, is something we're seeing. And then, you know, new fintech solutions, where, you know, often suppliers, you know, may go directly to fintech, sell invoices, you know, and cut out the buyer. So that's an alternative. And, you know, the use of DLT, we talked earlier, blockchain type contracts are going to become more important to all stakeholders, but especially buyers setting up these programs, to really get visibility of the supply chains, of the invoices. So buyers themselves also have that visibility, and they're not dependent on the payment agent, be that a platform, be that a commercial bank.
Excellent. Seb, you alluded there for a moment to technology and dynamic discounting. I have to obviously bring Bob in here, because Tolya is not only a reverse factoring platform of immense repute and power, but it's also a dynamic discounting facility as well, isn't it, Bob? And perhaps you could also address this question about technology and how it can prevent. I have a question here. Does any bank currently use blockchain involving suppliers and buyers in order to have visibility and control of invoice ownership, in addition to UCC filing or perfection procedures? Which is an excellent point. Thank you very much. Bob, thoughts, please.
Yeah, I mean, absolutely. You think about it from a supplier's perspective, they just want to get paid early, and there's a whole bunch of ways you can do that. You can have a third-party financial institution, reverse factoring, provide that. The buyer can do that directly and just make an early payment. There's a lot of different tools there, whether it's on the blockchain or if it's in a platform. It's really providing that visibility, which is helpful. And there's a lot of different tools to do that, and different companies do that in different ways. And I think to the prior question, what should suppliers and buyers consider? You think about the title of the session is, the anatomy of a bad deal. And that's true. There are some of these bad situations, but the vast majority of this is really positive. It's helping small businesses. It's helping supply chains. There's a ton of value being provided. It's like when you hear of a plane crashing, maybe you don't want to get on a plane anymore, but you don't hear about the thousands and thousands of successful trips, the value that air travel brings of getting people somewhere very quickly, safely, and efficiently. And so I would just highlight that as you got to understand the bigger picture. And I'm fortunate that I get to see it every day. And I've talked to businesses that have said, if it wasn't for that early payment program, my company wouldn't be in business today, or we wouldn't have been able to grow the way we did. And so I think it's, yes, the intent here today was to talk about the bad, but don't take all these negative things as a broader perspective of the industry, when really it's providing a great service. And it couldn't be any more the case since the start of COVID, when businesses struggled, and it was a great piece for that.
Well said, and bravo. Rakshith, I know it's nearly your bedtime, but I can't let you go without commenting a little. I mean, a lot of these suppliers are in Asia. The pandemic obviously seems to have been rife with potential fraud. To what extent do you think some of these points regarding risk and supplier performance and due diligence in the underlying transaction are relevant in your part of the world?
It is very relevant, Tony, but probably, taking a step back, right? When you really look at payable finance, it's not only a means for buyers and suppliers to optimize working capital, but I think what's very important is it's a means to also strengthen relationships with each other. And we see that in so many cases where buyers genuinely work with suppliers to develop and grow that relationship. There've been so much of views by various industry forums into providing principles and suggestions around best practices, and we discussed many of them. But I think what's important to note is, if done in a reasonable and appropriate manner, there are very significant benefits in terms of payable finance for all parties involved. And whether it be in exceptional circumstances or in normal circumstances of business growth.
Yes, the old days of buyers rule, sellers drool, heads I win, tails you lose, seems to be gone, thank God, and it's now more of a mutual supply chain benefit for both parties. We're very close to the end of our time. I have a couple of extra questions I'd like to ask you guys. So one of the questions here is, does the SCF industry need to develop a better set of standards for self-governance to avoid punitive regulation. This is a question about self-governance as opposed to regulation. There are certain people who believe that there's definitely more regulation required in the arrangers and the sponsors, like, for example, Greencell should have been regulated, not just its bank, which was, but others, like this questioner, is believing it should be self-governing. What's your view on that, panel?
Yeah, I think BAFT is getting more and more involved. One of my colleagues, chairs the BAFT Supply Chain Finance Committee, and the focus on this is getting a lot more, bringing into the tent some of these platforms. So it's not just the banks. So these platforms are part of the industry and therefore have that peer pressure. It's something that we're having a lot more visibility on. So I think that's right. And I think we are starting to see that happen.
Any other comments on that from others?
Yeah, I think we are definitely growing and evolving as an industry and getting stronger and stronger at this. I also, I think the way the question was phrased was that regulation would be bad. I don't think that's necessarily the case, right? So I think the more transparent things are, the clearer things are, the more people understand the boundaries, the quicker people can actually move because they know what's okay and what's not. It's when there aren't those definitions. So whether it's regulation or it's the industry or others, I think the end goal is the right thing, and how we get there, it doesn't make much of a difference.
Clearly a balance. Clearly one of the reasons why we have like a $1.5 trillion gap in trade finance for SMEs, particularly in Asia, is because banks withdrew from trade finance because of regulation. So there needs to be a balance here for sure. I think we're out of time. Are there any final comments that any of you guys would like to leave with the audience in terms of your thoughts about the Greencell disaster, payables finance specifically, and the opportunities for working capital finance for companies involved in international trade? Rakshith, would you like to sort of give us any final thoughts?
Sure, Tony, and going back to my point again, right? When you look at global supply chains, they're incredibly complex, right? You have people in different countries bound by different regulations, speaking different languages, dealing in different currencies, all trying to make this global supply chain work. And in a way, payable finance is, taking quotes of one of the forums, a force for good, right? And if applied properly, and I think vast majority of it is applied properly, there are huge benefits to all parties involved. And I think we should continue to keep our eye on that and continue to grow in an appropriate manner.
Thank you. Seb, can I ask you for a final thought?
Yeah, I think Rakshith just summed it up. We're seeing more demand. It's more important as the economy starts to get going again. There's plenty of investor appetite. It's healthy to have multiple parties be involved in arranging these. It brings good competition. It brings innovation into the sector. So there's a ton of good stuff happening, and the industry is evolving in the way that it needs to evolve. And all parts of finance have bad apples where things go wrong. We saw it at length in 2008 in securitization. So what we're dealing with here should not be a surprise to anyone, but we learn the lessons and we try and do things better going forward.
Bob?
Yeah, I think we're all kind of aligned here, right? There's a ton of value. It's a force for good. Don't let the negatives here stop you, but take the time to understand what's really going on, and hopefully for all those out there, approved payables finance will be a really great tool for them.
Thank you. And Todd?
Really summation the rest of the panel. I think we could all agree that the failure had nothing to do with payables finance, supply chain finance, working capital finance, or trade credit insurance. It was potentially deals poorly structured. And as now that time has passed and people are actually seeing and what really went wrong, hopefully the confidence in these type of structures and traditional trade finance, supply chain payables, it comes back to where it should be, because it works when done properly.
Thank you. So, as I said at the beginning, we've picked over the cadaver of Greencell. We have managed to avoid getting blood too far all over us. We've discovered the anatomy of what payables finance should be, and we've given some prescriptions, if I could extend this point a little further, as to where to go in the future. I want to thank all my panelists. You've been a dream team on this subject, a real delight to work with. I hope the audience has been equally enthused and informed. And thank you very much indeed, GTR, for giving us the opportunity. We look forward to being back in the future.